little more than half an hour until the opening bell on Wall Street. Joining us now, Kathryn Rooney Vera, who's the chief market strategist at StoneX. We've had so many insiders today talking about whether we're too optimistic, whether the optimism of the holidays is bleeding over into the new year, or whether there's cause for concern that after such a big run-up in the markets, that we're kind of overdue for some big pullback. Set the scene for us.
Well, I heard a phrase today, weaponized FOMO, and I think it makes sense. There's indiscriminate buying now. So everyone's very positive, expecting that the Fed hikes cuts more than 150 basis points. What I would say is, fine, keep your long positions, but hedge them. I mean, the VIX is very low. You can get cheap puts, and I think it makes sense. So if you're going to stay long and overweight the Magnificent Seven, overweight triple Qs, overweight S&P market cap, I would say start to take hedge positions, and that doesn't have to just be buying puts. That can be buying gold. That can be buying tips. This is the just-in-case trade that I think is cheap right now, and I think is prudent.
The interesting thing about a weaponized fear of missing out is that we're seeing the S&P only half of 1%. From a record high that we haven't seen in 2 years. And you know, the psychologists in some of these advisors say people don't like to buy when you hit that peak, that if they are not in it already, now is not the time that they're getting, that they feel like they want to get in it. Do you think that that's the fear of missing out overwhelms then the fear that I've already missed out and I'm just going to stay and wait for it to come back down?
There could be that, but I do get a sense that there is this still this AI trajectory that everybody kind of wants in. So the tech sector is very strongly held, especially in retail guys' portfolios. And what I would say is be careful with that, because if the Fed doesn't cut as much as is currently priced in, which I think is an inordinate amount, then you could see some headwinds and some serious ones on the cyclical sectors.
Another interesting dynamic of 2023 is that your traditional stocks and bonds portfolio returned about 17% this year. Is that still going to be something that carries over into next year, especially as we look at just the prospect of rate cuts and all sorts of other cash shifting trends that took place this year?
So I like fixed income, but the biggest headwind or risk to the fixed income space is positive correlation and the continuation of positive correlation with the equities and fixed income space. I doubt that continues. It's historically very unlikely to continue. It's an anomaly. It's an aberration from financial reality that you have that positive correlation. And the reason that you had it is because of high inflation. Inflation is coming down. Whether it continues to come down because of immaculate disinflation or because of recession, I think that's still to be determined. But the fact is, I think that the negative correlation will return, lending additional credibility to the 60-40 portfolio.
Kathryn, how much of your clients' money right now is in one-year treasuries maturing in February, March, and April? How much right now is in money market funds?
Yes.
And what are you telling them to do with that money when it matures?
If bond yields continue to move lower for good reasons rather than recessionary reasons, that money is going into equities.
Boom. Don't pass go. Don't collect $200 in a money market fund. Just go right in equities.
If bond yields can move lower because the U.S. consumer rolls over, which I think is an underpriced risk for many reasons, that's not good for equities. So my advice, Steve, is to hold on to those juicy two-year treasury bills that out-earn the S&P 500 right now. Have a nice, hefty allocation to fixed income. You know, the steepener trade, I think, looks good.
So you're saying take those 1 year and roll them back? Roll them back into ones, roll them back into twos?
Look, I think it makes sense. I think the Fed is going to be cutting. I think steepeners make sense right now. And I think having a hefty position in fixed income is a good bet, especially if we get this negative correlation returning.
But not in the money market fund?
I think you should have a hefty cash position, and you're going to roll it into short-term duration fixed income, yes.
Kathryn Rooney, thank you very much.
My pleasure.
Thanks so much, Kathryn.